Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. This is The Talking Point. It is September 25th, and the market is opening lower this morning. Now, obviously, we know from week after week, day after day, the market can change course during the day. But you've got the 10-year Treasury yield right now at 4.5%. The market is susceptible, vulnerable to those headlines in terms of the 10-year Treasury yield. As the yield comes down a bit, as we saw last week, the yield came down a bit. Why? Because the S&P Global look at the service sector in the U.S. showed a downdraft. And what that did was it pushed the 10-year Treasury yield down just a bit. What that did, in turn, was to help underpin the market to climb higher. However, what we saw towards the end of the week was, as the market was actually in the green, we had two Federal Reserve officials speaking, and each one made it very clear that the Fed is prepared, essentially, to raise rates if needed. If needed. I want to stress that, if needed. And that just turned the market into the red. So you have a market that is extremely headline-driven at this point, and that is waiting for some of the headwinds to dissipate, to ease. So let's go over this for a minute. This week, obviously, the market is focused on whether or not Washington can come up with an agreement to keep the government funded. That's number one. The market is very much focused on that. And one of the reasons specifically is what happens to consumer discretionary. It's already under pressure, as you can see the sector, with regard to higher energy costs, gasoline prices going up, and also to the 10-year Treasury yield climbing higher, higher rates and higher energy costs, not to mention higher food prices. So we've seen consumer discretionary under pressure. But then think about this. What happens if the market believes and the country believes that the government can shut down for a week, 2 weeks, and they don't receive the checks, their benefit checks, Social Security, for example? Then consumer discretionary will come under even more pressure, most likely, if they feel that they're going to have to wait until they are hitting their checking accounts. So there's that headwind. The other headwind that the market is facing is whether or not oil prices continue to rise. That's one that feeds into gasoline prices climbing higher. And also the 10-year Treasury yield, if that continues to move higher and then hurts the stock market, pushes up variable rates, whether it's credit cards and so on. So that these are headwinds that the market is working its way through. Now, without the benefit of being in the, what shall I say, the official earnings season, which begins officially on October 13th with J.P. Morgan, the banks beginning their earnings calls. The market, is subject to quite a bit of the headline effect, but also the seasonal effect. And sometimes, you don't have the seasonal effect, the negativity of a season affecting the market. This year, it has. Obviously, for August, for September, seasonality has been almost textbook-like. Now, as we leave this month, October through the end of the year tend to be stronger months for the market. Now, I will say, October, if you look it up, you go onto Google and you look it up. October, what about seasonality in October? You'll see that October has the reputation of being the bear killer. The bear killer. More bear markets have been killed in October, and therefore it has that reputation. But it also shows that the market tends to climb higher. Overall, it's not done completely, but overall, generally, and goes into what they call a sweet spot going into November to December. So again, a lot depends on eliminating some of these headwinds, allowing the earnings season to begin, and hearing what companies have to say about their earnings, the guidance that they're giving, and whether or not the market's interpretation that we are bottoming in terms of the earnings recession, and to see what, as we get into the third quarter earnings season, if we see again that the bottoming continues to lead us to a positive earnings period. So these are all part of the headwinds that the market has got to navigate as we get toward the end of the year. This week is going to be particularly important for the market. Again, more Fed speakers. We want to hear what they have to say, but keep in mind, I mean, if you looked at the market last week and you were literally watching the volume in the market, the turn in the market, when the Fed speakers, two of them, spoke about the possibility of another rate hike if it was needed, and I have to stress that, if it was needed, the market turned. So this week we've got new home sales coming up. Expectations are that for the month of August they come down a bit. And also we've got consumer confidence, whether or not that holds. It is important. Consumers have been saying that they are worried about new jobs. They're worried about the ability to get new jobs. They are concerned about the higher prices. But so far, and I have to stress this, so far, consumer expectations for inflation climbing higher over the long term have actually not materialized. This is something the Federal Reserve watches very closely. You heard Chairman Powell mention this, that consumer expectations for inflation remain well anchored. All that means in regular English is that consumers have not felt that inflation is going to rise in a dramatic way over the next year, 2 years, 3 years, 5 years, and so on. So this is something that we are going to be watching because it matters to the Federal Reserve. They don't want consumer expectations towards inflation rising and rising in a meaningful way. So again, we'll have consumer confidence. Also, durable goods will come out on Wednesday. I pay very close attention to this, especially a component within durable goods, which is really a look at capital spending from companies, capital expenditures. And why is that important? It's important because if companies feel confident about the future, they are going to spend more for upgrades. I mean, that's what it comes down to, upgrades. But if they feel that their sales are going to be down, they're going to have margin pressure, meaning that, the input costs are just too high, they may hold off, and we pay attention to that. And then this is also extremely interesting. Initial unemployment claims. They have been holding steady. So if folks that are looking for cracks deepening in the labor market, the initial unemployment claims have been holding steady, indicating that the layoffs have not been dramatic enough to push people, towards filing for unemployment claims. Also, we're going to get a GDP revision on Thursday morning, and this would be for the second quarter. Expectations are, by the way, that it could actually, when I say expectations, I want to put an asterisk here because I hear folks say, Quincy, what does that mean, expectations? We look at consensus estimates. All of the analysts, come out, and then there's an average of what the analysts have to say and what they think. So the consensus estimates right now are, believe it or not, that Q2, second quarter ended actually higher, perhaps at 2.3% rather than 2.1%. Also, Chairman Powell is supposed to speak on Thursday afternoon. We will hear what he has to say and whether he adds anything to the backdrop of more than what he said at the September meeting at the Federal Reserve. Now here, this is one for Friday, and I have to say that if there is one day this week that the market is most closely focused on, and it comes at the end of the week for the market, the 29th, it has to do with the PCE, the Personal Consumption Expenditures Index. This is the Fed's preferred view of inflation, and the hope is, for the market at least, is that the core, because they're focused on core, that core year over year comes down. And that is what the market is going to be focused on. The 10-year Treasury yield is going to be focused on it, as will the 2-year Treasury yield, which, by the way, is the most sensitive to Federal Reserve policy. You remember, as that S&P Global report came out about a weaker consumer sector, the 2-year Treasury yield actually inched down just a few basis points, as did the Treasury, as does the 10-year, the 10-year Treasury inched lower. That helped actually underpin a rally in the equity market. But as I said, right now, this market is extremely focused in whether or not the trajectory for the 10-year Treasury yield is higher than where it is as I do this call, which is 4.5% on the 10-year Treasury. And so the expectations are that the core, again, a year over year, will come down to approximately, this is consensus now, 4%. So that would be good news for the market. The question is that enough for the Fed? Is it enough for the Fed to basically stay on hold for the rest of the year? That's the biggest question. Or do they feel as if they do have to basically come out with another rate hike either in November or December? You will see that the Fed funds futures market, which is about probability of rate hikes, where is it going, where is it headed, that will change. It will change as that core PCE comes out 8:30 in the morning on Friday. So it's an important day for the market. Also at 8:30, and this is also very important, and I'll explain why. Personal income comes in. This is for the month of August, and personal spending. The reason this is important is that what we saw was that we saw personal income coming down while consumer spending climbing higher. That's not a trend that you want to see. You don't want to see that for obvious reasons. So the consensus estimates right now for August actually indicate, again, it's just consensus, that we may see personal income climbing a bit higher and personal spending equal to personal income. Keep in mind that a lot of Americans, just take a look at the numbers, have put their holdings in higher bearing accounts. So they're receiving some extra income there. And that's important because we tend to dismiss that as a possibility to help fuel spending. We always have to remember that the U.S. consumer, this is why there's so much focus on the U.S. consumer, is 68% of our economy, of our overall GDP. In closing and explaining again what we're focused on, we are looking at surveys suggesting that the holiday season is not going to be particularly strong. In fact, many of the surveys are suggesting that consumers are saying, no, I'm worried about the jobs market, I'm worried about higher prices. Let's keep in mind that the back-to-school sales also, as we went into actual shopping for back-to-school sales, there were surveys from some very prominent, consulting firms suggesting that back-to-school sales would be lower than last year. In fact, they held up. They were quite strong. We pay very close attention because it really does reflect consumer sentiment. And back-to-school sales, despite the higher prices, consumers have been looking for sales. They will go to stores where they are offering a better price, but they did spend. The next season, by the way, happens to be Halloween. Halloween spending in this country has picked up dramatically. And I'm not talking about just candy for trick-or-treaters. I'm talking about Halloween parties that adults are having and the costumes for adults and for children. We'll keep our eye on that to see whether or not spending continues to be strong, taking us into the overall general holiday season. And we'll pay very close attention this week on Friday, which if I had to choose one day, that is so important for this market, and leading us out of August and September, the two weakest months traditionally for the market. It will be personal income, personal spending, and the PCE, Personal Consumption Expenditures Index. These are extremely important and will help us with sentiment, not to mention the 10-year Treasury yield and the 2-year Treasury yield after these reports come out. Have a very good week. Thank you so much, and we'll be back next week. Thank you. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.